Hello students. In the next few videos, we will learn about terms in accounting. This particular video is part 1 in terms in accounting, where we will discuss around 6 terms. Let's look at the terms that we will discuss in this video. The first term, entity. Next, business transaction. Third term, account. Fourth term, owner. Fifth term, capital. And the sixth term is drawings. So these 6 terms will be discussed in this particular video. Let's go on to understand about the term entity. First term, entity. An entity refers to a thing which has separate individual existence. Now, when we talk about a business entity, it refers to an economic unit carrying on economic activities. What are the examples of business entities? It could be Reliance Industries, Bajaj, Maruti Limited. All these are examples of business entities. The stationery shop next to your house, that is also an example of a business entity. The pizza outlet next to your house, that is also an example of business entity. So we are talking of an economic unit which carries on economic activities. What are economic activities? It could be the purchase or sale of goods. It could be a financial company which gives and takes loans or deals in securities. So all these are examples of business entities. Next term, business transaction. A business transaction is a financial transaction. It involves money entered into by two parties and which can be measured in terms of money. A business transaction brings about a change in the financial position of the enterprise. What is financial position? The position of assets, liabilities and capital is called financial position. How does it arise? It arises out of transfer or exchange of goods and services. It has dual aspect. One aspect is called the debit aspect and the other aspect is called the credit aspect. There are two types of transaction. It could be a cash transaction or it could be a credit transaction. In the case of cash transaction, when the amount is transacted immediately on entering into the transaction, it is called a cash transaction. When is it called a credit transaction? When the amount is promised to be paid later on, it is called a credit transaction. To give you an example, let's say A purchases goods from B. After the purchase, A pays money immediately to B. It is called a cash transaction. However, if A tells B, I will pay you money at a later date, then it is called a credit transaction. So that is the difference between a cash transaction and a credit transaction. Now you can define transaction as difference between external transaction and internal transaction. An external transaction is a transaction which involves a second party, like the business purchasing goods from Mr. Sudhir. Mr. Sudhir is a second party who is involved in the transaction. On the other hand, an internal transaction is transaction which does not involve a second party. For example, depreciation charged on machinery. So the cost of the machinery is divided over its estimated useful life, and that is called depreciation. We learn the meaning of depreciation in greater detail when we come across the depreciation chapter. So if it involves a second party, it is called an external transaction. On the other hand, if it does not involve a second party, it is called an internal transaction. So a business transaction is a transaction between two parties which involves some money and which results in the change in the financial position of the enterprise. There are two types of transactions, cash transaction and credit transaction. A cash transaction involves exchange of money immediately. A credit transaction does not involve immediate exchange of money. Similarly, a transaction may be an external transaction or an internal transaction. A transaction involving a second party is an external transaction, whereas a transaction which does not involve a second party is called an internal transaction. Next term, account. An account is a summarized record of transactions relating to a particular head at one place. So, a cash account will have summaries of transaction relating to cash. Salaries account will have a summary of transactions relating to the head of salaries. In an account, not only is the amount of the transaction recorded, but also their effect and direction. For example, the purchase of goods, whether you purchase in cash or in credit, is shown in the purchases account. So let's say we have an account called Rahul account. When goods are sold to Rahul, it comes on this side. Two sales. Let's say 10,000 rupees. Let's say Rahul pays cash of 6,000. It comes on this side. And the balance which has to be still paid by Rahul will be 4,000. Now this is an example of an account of Rahul wherein all transactions relating to Rahul is recorded in the same head. When you sell goods to Rahul, you put it on the left side. When Rahul pays cash of 6,000, it's put on the right side. And the balance which Rahul has to owe to the business, which is 4,000 rupees, is also on the right side. This is an example of an account, a Rahul account, wherein summary of all transactions related to Rahul is recorded. An account is in the form of a T shape. Next term, owner. A person who invests money in the business and also bears all the risks of the business is called owner. Let's say there is one Mr. Gupta who wants to start a stationery shop. Let's say he invests rupees 5 lakh to start this business. Now Mr. Gupta has invested rupees 5 lakh in the business, the stationery shop which he is going to start, and he will be bearing all the risks. If there is a profit, he takes it, but if there is a loss, he has to bear the risk of loss. Mr. Gupta is the owner of the business of stationery shop. Next term, capital. the amount which is invested by the owner or the proprietor in the business, that is called capital. Now this amount which is invested, it can be in the form of money or it could be in the form of assets having monetary value. The amount of the capital will increase with the additional capital introduced and the profits, and it decreases with the drawings and the losses. So let's say Mr. Gupta, who starts the business with investing rupees 5 lakh as his capital, if he introduces additional capital or if he earns a profit of, let's say, 50,000, now the amount of the capital becomes 5,50,000. Let's say he incurs a loss in the next year of 20,000. Now the amount of the capital will be 5,50,000 minus 20,000, which is 5,30,000. Now we said the amount invested by the owner or proprietor in the business is called capital. So if the business is a company, then who are the owners of the company? They are called shareholders. So in the case of company, the shareholders are the investors as well as the owners of the company. Now there is a concept which is called business entity concept. As per this concept, the amount which is invested by the proprietor in the business, it is considered as a loan given by the proprietor to the business. The business is a separate business entity, and when Mr. Gupta invests 5 lakh in the business entity, which is a stationery shop, owes Mr. Gupta rupees 5 lakh. So the amount of capital of the proprietor which is invested in the business is a liability for the business. Why? Because the business is a separate entity from that of the owner, and all transactions are recorded from the point of view of the business and not from the point of view of the owner. So Mr. Gupta has invested 5 lakh in the business. The business is a separate entity. It is as though Mr. Gupta has given a loan of rupees 5 lakh to the business. The stationery shop owes Mr. Gupta 5 lakh. It is a liability which is owed by the stationery shop to Mr. Gupta. Now, whenever the transaction is recorded, it is always recorded from the business point of view. So, the amount which is invested by the owner in the business is a liability for the business as per the business entity concept. Capital is also called owner's equity or net worth. That is another name for capital, owner's equity or net worth. Now the formula to get the capital is equal to assets minus the liabilities. Last term in this video, drawings. Money or goods which is withdrawn by the proprietor from the business. This is important for personal use. Only if he takes it for personal use, it could be money or it could be any goods, or in fact it could be assets also. It is called drawings. And when goods are withdrawn, the transaction is recorded at cost price. Drawings reduces the capital of the proprietor. We already saw this when we were discussing the terms of capital. So drawings reduces the capital of the proprietor. The amount of the drawings is debited to drawings account and then deducted from capital. So in this video we learned 6 terms. The remaining terms we will discuss in the successive videos.